Hi, I'm David Fisher, and I'm here once again with Group CIO Dan Iveson to talk about some of the recent discussions taking place in PIMCO's Investment Committee, or IC. So I think a lot of our clients will be busy digesting the implications of our recently published secular outlook detailing our view for economies and markets over the coming 3 to 5 years. Could you give us a sense for how this longer-term outlook has been influencing some of the recent discussions within the IC?
Sure, David, and maybe I'll start with the title of our research piece, that represents conclusions from this forum. It's entitled Rude Awakenings. And I guess the most simplistic way I can frame our outlook is that looking back over the last 10 years, we've had a period of relatively low real economic volatility, and by extension, relatively low financial volatility for the most part. Looking forward the next 5 to 10 years, we think economies and markets will exhibit very different characteristics. We think there'll be elevated uncertainty, and from a bottom line perspective, investors are going to need to be much more careful and cautious in many respects. In particular, we focused on risks going forward, a significant risk being political uncertainty, instead of a paradigm where markets were very much in control of the central banks. There are plenty of other sources of uncertainty, one of which is technological change, which in fact can have significantly positive outcomes on potential economic growth through the productivity channel. But even there, that could create some additional volatility and even weakness in high-quality bond markets. So the bottom line is that we believe this will be a market that involves more volatility, lower base case return expectations, at least on a hold-to-maturity basis, and surprises that can catch an unprepared investor off guard.
So part of the outlook in terms of the secular time frame is for a recession in the next 3 to 5 years. But turning to, say, just the next year, what would you say is the outlook? Do we expect a recession in the next year?
We don't over the next year. And we've talked about this now for quite some time. Despite some of these more recent bouts of volatility, in general, we think global growth will remain positive and somewhat synchronized. So we don't expect a recession near term, but risks have certainly increased. And you're absolutely right. Over the course of our secular horizon, again defined as a 3 to 5 year period, we think there's a material chance of recession. And anytime you have that view, it warrants caution, particularly within the credit-related sectors. Although we do acknowledge that it's far easier to be able to highlight characteristics that will likely lead to a recession. It's very hard, even at PIMCO, to get the timing precisely right. So with elevated risks and always uncertainty around the timing of these events, we think it warrants preparation early. Early preparation gives us a better chance again to be able to weather any anticipated volatility and again go on the offense and take advantage of what we think will be markets that are prone to overshooting.
So one topic that's top of mind for investors right now is the direction of interest rates. There's a lot of concern that rates may go a lot higher. What's PIMCO's view? Over the next year, do we expect interest rates to go much higher or to be more range-bound?
Sure, David. So first of all, it's a legitimate concern to worry about higher interest rates. We are at the latter stages of the U.S. economic cycle. And PIMCO's base case is that interest rates will likely trend higher from here over the short term. But unlike some market participants, we don't think higher interest rates are guaranteed. We think that there are plenty of scenarios where interest rates can go lower from here. And in fact, over the course of the last few weeks, when we've seen volatility coming out of the emerging markets, as volatility has crept back into the periphery of Europe, those days where fear has returned to markets, we've seen high-quality bonds rally. So PIMCO is cautious over the short term. We think it's far too premature to declare that we're in a multi-year bear market. We think ultimately over the next few years at least, rates may be a bit higher, but it's going to remain relatively range-bound. So the bottom line is that we're cautious, but we're not void of high-quality bonds. We think they still serve an important diversifying benefit across many states of the world where investors are suffering drawdowns elsewhere in the portfolio.
So valuation, certainly a bit of a concern still in markets. Where does PIMCO see pockets of value even in this late cycle environment?
We are of the view that the U.S. housing market continues to exhibit strong fundamentals. even in the face of slightly higher mortgage rates. That's an area of the market that's been heavily regulated. It's an area of the market where you haven't seen the type of excessive risk-taking that we've seen in certain pockets of other sectors. And that's an area where we remain quite active. In general, we're trying to be quite defensive, and we're looking for credit-related assets that have strong, visible, high-quality collateral backing them. So that includes additional opportunities within the asset-backed markets, within the secured corporate credit markets. And then more recently, we've begun to see more volatility in emerging markets. Now again, we could talk for hours about what's going on from more of an idiosyncratic perspective in emerging markets, but the recent repricing that we've seen, at least partially due to pretty strong strength in the US dollar, is presenting some attractive diversifying opportunities for us as well. Then another area that looks interesting, and again, it's on a credit-by-credit basis, would be within the financial sector. That's been a sector that we've liked in the past, but in some areas where we've seen a little bit of widening in spread, a little bit better yield compensation, we've been finding some opportunities to add some risk for end investors. Then the final point relates to the high-quality bond markets. We've seen a pretty big rally in segments of Europe of late, and we're at pretty wide yield differentials when you look at US interest rates versus much of the developed world. And again, we're cautious and respectful of uncertainty in terms of these relationships going forward, but there have been some opportunities to take advantage of very wide interest rate differentials from a historical perspective in response to recent volatility. So again, a preference for the US over some duration markets in Europe, a preference for the United States bond market versus Japan as an example still looks attractive to us.
Great. Well, thanks for joining me today and for offering your thoughts, and thanks to you as well.